I'm at REITWorld 2010 in New York City, and joining me is Mike Fascitelli, President and CEO of Vornado Realty Trust. So Mike, do you expect your company to be a net buyer or seller of assets when everything's said and done?
I think we'll be a net buyer in 2011, not a net seller.
And Vornado seems to be moving more into the joint venture, some different types of strategies. Can you talk a little bit about those?
Yeah, well, I think we've been traditionally a company that's funded everything from the public markets, and I think we're looking for alternative sources of funding sometimes because deals have gotten so large in New York City or that we're limiting concentration risks, and we took on a joint venture partner in 2 Washington, D.C. assets recently. So we raised a private fund to co-invest with us to establish those relationships and also make our capital go further. So we have plenty of capital. But we also thought it would be very prudent to expand ourselves into the private funding market for either individual assets or for the fund.
And what's the competition like for the assets that Vornado desires?
High. I would say one of the things that is fortunate is we were able to, a long time ago, build a great asset base in New York and Washington, D.C. And the good news is that in New York and Washington, D.C. are 2 of the best real estate markets in the country, and we're both in office and retail in those markets. And their very performance of our operating performance has been unbelievably great. Same-store sales growth, rental growth, redevelopment opportunities. On the bad news front, there are 2 markets everybody wants to be in, so buying things has been competitive because capital flows are quicker now than they ever were before. If you go around the world and talk to worldwide investors or U.S. investors, New York and D.C. are 2 of their favored cities right now. So, we're lucky that we have $30 billion of assets and they're working for us in those cities. We're unlucky in the sense of, we're competing against capital from all over the place and trying to buy new assets in those cities.
And what do you think should be or has been the lesson that REIT executives should learn from this most recent economic distress we've been through?
There's a few lessons. I mean, certainly one is that balance. I had a professor at the business school who said balance sheets don't matter until they matter, and then they matter a lot. Balance sheets matter. Leverage is risky. And for people who didn't prepare for any kind of downturn, and I don't think anyone saw the severity of the downturn and the viciousness of the downturn and the speed of it and the slope of it, that meant that they had to take defensive actions that really were very painful in terms of dilution for the other shareholders. But they had to do that to ensure survival. So I think going through this, I think you'll see probably lower leverage in all of the real estate cycle for quite a while because the private market was even more on that drug of leverage. So I think the leverage is risky. It works great on the way up. It works bad on the way down. So I think people's lessons were you have to be mindful of the leverage.
Great. Mike, thank you very much for joining us.
Thank you. My pleasure. Take care.
For more from REITWorld 2010, be sure to visit REIT.com.